Well, hello everybody. I think it's been a couple of weeks since we've done a live stream on the housing market here in Southern California. And, it's not often that I'm truly surprised and something happens that I really didn't predict. And whenever that happens, I like to dive into the data and say, if we're not getting something that we predicted or that we thought would happen, the reason is what have we missed, right? What are the other signs that are going on? I don't really think anything is a fluke. So let's go ahead, get started, and dive into it. My name is Stephen Meade with Domicile real estate for people who love houses. This is our Southern California housing market update for February 11th, 2025. I can't believe we're already in the second month of 2025. Uh, this week, we're seeing some market movements that are kind of interesting to me. Normally, our market has a very interesting arc here in Southern California. We see that the level of listings usually reaches a low point, sometimes around the end of the year. Things then start up, and that level of listings and homes coming in the market, it kind of grows through the spring, coasts through the summer, and then kind of slows down as we go into the end of the year. We don't have quite the seasonal effects of the snow states. Things, it's not as much of a wide variation, but we still kind of generally follow that same pattern every single year, except for this one. Let's open up the charts and I'm going to tell you what I am talking about. So if you take a look here, let's start off with total active listings. Now, if you take a look at where we were at this point last year, we were in that spring uptick, which kind of goes through the summer where it kind of coasts through and crests and then falls off to the end of the year. And in fact, if you look at last year, that is exactly what happened. But something is going wrong here. And that something that's going wrong is we are seeing that the number of active listings has really flattened out. Now, in all fairness, that number is still a lot more than we were at this point last year. And we didn't quite dive to the same low level of listings as we did last winter. So that might have something to do with it, right? Maybe the market is readjusted to kind of a new floor, but it's very unusual to be going into February and just see those new listings just kind of fall off and just plateau out. That is not a normal reaction in spring, as you can tell by sort of looking at where things were at last year. And if we take a look at our chart here, we can kind of see a little bit about what's happening. And I think this is really important to understand. And if you look at the right side of this chart, this is new listings that have come on the market in the last 14 days. Blue line is under $1 million. The red line is homes between 1 and 2 million. Now, if you look at this, you see something else that's very strange. Now, we do have some variations, right? Like you'll notice both of these graphs are ripply, right? They're not perfectly linear. There's definitely ebbs and flows, but this is a very strange shape. If you look on the right-hand side of your screen there, when you're looking at this, I mean, this is really just a reversal. It's like we were heading into that spring new homes coming in the market season, and it's really just kind of pulled back. Now, my question when I look at this data is I think, are we pulling back, or was that rise that we saw 2 weeks ago, was that an artificial high? Was that the result of maybe a bunch of people who were going to put their homes on market? Fires happened. They just kind of held off and said, not really a good time to be launching a new listing. I think that might be part of it, right? And you'll notice even the level we're at is still higher than where we were at it last year in terms of the number of new homes coming on the market. But I think there might be something here. I think we might be seeing that this year is really seeing fewer listings hitting the market. And I'm really curious in 2 weeks if we're going to see this trend continue, if this is just going to kind of flatten out, because you'll notice we're not anywhere near that level of new listings hitting the market that we're typically at by April of this year. If we look at new escrows, we also see a leveling out too, but there's a difference. These are still pointed upward, right? So maybe there's a little bit of a leveling, but they're still pointed in the upward direction. Both of these, or rather the under $1 million is a little bit less than we were at last year, but that 1 to 2 million is actually higher than we were at it last year in terms of those listings being taken off of the market. If we look at our absorption rate, we also had kind of a bit of an anomaly. You'll see those kind of wild gyrations that happened. A lot of that's holiday timing. And then I think we got kind of a double jump, right? Or kind of a double ripple with the fires, where you see those kind of massive market gyrations. We saw, obviously you look around there, looking backwards from January 14th, the number of, that absorption rate just took a real dive when I think people really kind of took a time out from the home market. And then it's kind of bounced back a bit to a level that is still a little bit less than last year, but I mean, climbing pretty rapidly. I don't think that's going to reverse course anytime soon. If we look at our close prices, that tells kind of another interesting story. So we've divided this into sort of three price categories. The 25th percentile, so that's kind of like the bottom 25% of the market. 75th percentile, that is the top 25% of the market, that point right at that top 25% level. And then the median, which is, of course, the middle. All of these are pointing upward, but remember, this is a look in the rear view mirror. This tells you what happened in the market. You'll see a big decline and kind of a little bit of a bounce back. But one thing I want to pay attention though is all of these prices are either at the same point or a little bit higher than they were at the end of September of last year. So pretty much that means if you were waiting for sort of like a wintertime lull, that wintertime lull is already kind of in the rearview mirror and passing. If we look at percent active after 14 days on the market, this is kind of my sort of more proprietary figure that I like to look at when I'm trying to determine market competitiveness. Absorption rate is not always it. This tells us about the new listings that have hit the market, how much are buyers snapping these up, right? And when this number starts to go down, it means a more competitive market. You'll notice we are a little less competitive than we were at the same point last year, but we are more competitive than we were at for most of the fall and late summer. So, in terms of where are we in the market, I think, this is going to be a year where I think we're still at a level of what I'd say normal competition, or at least post-pandemic, more normal competition. And if you look at our list close ratio, this is another one that's a little bit puzzling, right? Are those homes closing? Guess what? We thought that era of the average being over the list price was over. And now we are seeing homes have swung back to that 100% mark, which means on average, the average listing sells for 100% of list price, or really close thereabouts, or right at list price. That seems to be, if you average it out, that's where it works out to be. And if you look at our days on market for new contracts, this one I find really interesting, right? If you look at under $1 million, it would seem that things have stabilized right around that 40-day mark. But if you look for that 1 to 2 million, that number has taken a dive. So if you look throughout history on this graph, these actually track pretty close together. This is one of the few times where there's probably the biggest gap between 1 to 2 million and under 1 million in terms of days on market for new contracts. And what I find really fascinating about that is that not only is it the biggest gap, this is a gap where those days on market for 1 to 2 million is actually the quicker sale. Those more expensive homes, you can see that generally speaking, they're either close together, or the more expensive homes take longer. The new ones that are actually going into escrow tend to have a little bit more seasoning on them. But again, remember, this is an average days on market for the entire market. This is days on market for the homes that are actually finding buyers. So this tells you a little bit about which homes are going into escrow. And the reality is the ones that are going into escrow, whenever you see this number be a little bit higher, that's usually a sign that can sometimes, or it can be sometimes be a sign that there's a quality issue with the listings that are available, right? If you start to see that happening, it could both mean the market is less competitive, but it could also mean a quality issue, that buyers are not seeing the quality they want. Maybe they're going back to homes that were previously passed over in the market. They saw them the week they came out, they held out for something better, and it did not happen. Now, if we look at our affordability, one of the things we talked about last week was this crazy scenario where the rent index exceeded the payment index. And you'll notice we've got kind of our trusty red line there on the bottom, which is that CPI index number. Now, obviously the rent index, we're looking at LA and Orange counties here, and this is based on single family homes. Um, that market is going to be a little uprooted for a while. This is maybe not a completely natural result, but in a lot of ways, this is the market that you're facing. If you are a buyer out there and you're trying to decide, do I rent my next house or do I buy my next house? This is a real factor you're facing. You're going to be facing many displaced fire victims who are out there renting homes. And so while we might have had a little bit of a jump there in the market, the fact that these are pretty close together now is very interesting. And I don't know what kind of effect that's going to have on our market over the next 6 months or so. But typically, when we see that gap narrow like that, that provides a little bit of extra fuel on the buy side, right? Because think about it. If you're a consumer out there and, last week it costs $1,000 more a month to buy instead of rent, and this week the payment is almost the same. What does that tell you, right? Like how does that change your decision making? Well, the answer is it's telling you that maybe you should consider buying right now instead. Combine that with kind of a little bit of easing that we might have been seeing in the interest rates in the last week or so, and I think that's going to tilt people towards buying. So, when I look at these charts, right, obviously we're trying to make a decision on, or we're trying to figure out how do we make decisions today? What does this information mean to us? But we're also trying to look a little bit, what does this mean for where we think the market is going to be in 2 weeks or 4 weeks or 2 months or 4 months or even 6 months from now? And looking at this information, I I always come back to that idea of people have choices on where they live. And when that equation between rent and buying, that really, I think, drives a lot of behavior and whether there's room for prices to go up or not. People talk about affordability percentages, they talk about all these things. And I think those are all proxies for what we think consumers can afford. But the reality is, I think the proof's in the pudding. If you watch that relationship between buying and renting, and when those market rents elevate themselves, that really does have a factor on that calculation, and it gives room for that buy side to go higher. So, my relatively short-term outlook is I think we are going to have a spring where we're going to see a little bit of price appreciation, especially if there's some easing on mortgage rates. I think that's going to make that decision very easy for buyers. We're having a lot of people reaching out to us right now. And basically, the people who are reaching out now are going to be the people writing offers in a month or two. So, I haven't checked sort of the new mortgage applications index. I know the Mortgage Bankers Association puts that out. We've thought about tracking that and updating that every 2 weeks, because that does kind of give an idea of who are the buyers of next month going to be. And that's really where they come from. But I'm expecting our spring to be pretty brisk here. Beyond that, I can't really say. And obviously, a lot does hinge on the interest rates. There's a lot of political uncertainty going on that actually tends to dampen sort of buyers because they're worried about making such a big decision. So we're just going to have to wait and see. By the way, if you like this content, don't forget to like, subscribe, questions and comments. We do love those. And obviously, if you are in the market to buy or sell a home here in Southern California, we would absolutely love to work with you. But even if you're outside Southern California, we know a lot of great agents across the country that think like we do, and provide kind of that level of expertise and advice. So don't hesitate to reach out. We'd be happy to hook you up with someone. And yeah, we'll see you again real soon.